Welcome everyone to Vested Interest. This is Shane back for another stock pick of the day video. It is July 2nd, getting real close to 4th of July. Happy early 4th of July to everyone out there. Hope you have a great time. I won't be doing a video on 4th of July. I'm going to enjoy the day. We are going to take a look at a subscriber's suggestion here. Brad Rowland commented, always love your analysis. Would love to get your thoughts on CSX. He posted that 5 days ago on the Southwest stock pick of the day video we did. So tune in to that one if you haven't seen it yet. We are going to cover CSX. They are out of the industrial sector. They are a railroad shipping company here. Let's jump right in. Now, if you have not done so or you'd like to help out the channel, if you could do me a favor, hit that thumbs up button down below if you find any value in the content. Make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Make sure you click that notification bell so you're notified whenever we put out any new content. I do subscriber requests, so one more reason to make sure that notification bell is clicked. If you make a recommendation down below, you'll be notified whenever we put out any video that you suggest in the future. And drop a comment. Let me know what you think of CSX. Is it in your portfolio? Is it one you're watching? Is it one you're buying? Is it one you're avoiding altogether? Maybe it's one you're selling. Let me know. I'd love to hear from you down below. Now, this is the Vested Interest Stock Screener. This is how I go through the video. So we're going to look at the end and see if it meets 5 of 8. If it meets 5 of 8, that does not mean that I am investing. It just means it makes it onto my watch list. Now, that goes to 6 of 9 if it's a company like a bank or an insurance company. Then I throw in price to book. 1 being fair valued for banks, anything under 1 being undervalued, anything over 1 being overvalued. Now, that is a good rule of thumb for banks, but price to book does not necessarily mean that for all companies. For companies like CSX in the industrial sector or information technology sector or consumer staples, consumer discretionary, other companies beyond banks and insurance companies, if you look at price to book, you should be comparing their price to book for that company with other companies in the same sector and in the same industry, and then that will give you an idea of where they sit compared to their peers. Don't just blindly use the one as fair value for price to book on all companies. It just doesn't work that way. But we will run through this screener. This is how I set up the videos. It's also how I look at a company on a high level to see if I'm interested in investing. Thousands of companies out there. It gives me an initial screener to see if I want to do more of a deep dive into the company. Must meet 5 of 8 to make it onto my watch list. And then I do more of a deep dive into the financials, income statement, balance sheet, look at debt to equity ratios. I do look at price to book and compare it to some of its competitors. I also look at some other things like revenue. Is revenue growing? I look at margins. Are the margins expanding? I look at their debt. Are they paying down debt? Or are they taking on more debt? There's several other metrics that I look to. I like to PEG ratios, PEG ratios as well. So there's several other things I look at, doing more of a deep dive into the company, into their financials, into their balance sheet and income statement, as well as doing a discounted cash flow analysis to see the range I'm willing to pay for the company, and then wait for the company to fall into that range and buy it, trying to pair that with when it falls into somewhere where it sits at 15% of its 52-week low as well. So again, just because it meets 5 of 8 does not mean you should run out and buy it. That's just the initial screener. And you can adjust this screener. This works well for dividend growth stocks, but it might not work so well if you're a growth stock investor or looking for some value plays that don't pay dividends, right? Some of these wouldn't apply. Growing dividends, dividend payout ratio of 75% or less, dividend yield theory, none of those would apply to companies that don't pay dividends. Now let's jump back over here, and you can find out more information about this company if you check them out at their homepage, www.csx.com. That's www.csx.com. That is their homepage where I pulled all this information from, and that's really where you should start. You should really understand what a company does, how they make their money, so that you get some idea of what the business is and how they might be impacted. CSX Corporation, together with its subsidiaries based in Jacksonville, Florida, is one of the nation's leading transportation suppliers. The company's rail and intermodal business provide rail-based transportation services, including traditional rail service and the transport of intermodal containers and trailers. Overall, the CSX transportation network encompasses about 20,000 route miles of track in 26 states, the District of Columbia, and the Canadian provinces of Ontario and Quebec. And you can see here on the right their map. So they do have lines here in Michigan where I'm at, up into Canada, mostly on the east coast here of the United States, all the way down to Florida. CSX serves major markets in the eastern United States and has access to over 70 ocean, river, and lake port terminals along the Atlantic and Gulf coasts. the Mississippi River, the Great Lakes, and the St. Lawrence Seaway. The company also has access to Pacific ports through alliances with Western railroads. CSX moves a broad portfolio of products across the country in a way that minimizes the effect on the environment, takes traffic off an already congested highway system, and minimizes fuel consumption and transportation costs. So again, basically a rail shipping company here that ships products all over the East Coast and into Canada. Now, the reason we are taking a look at them, they were actually up today, but because they were a subscriber or a recommendation by a subscriber, I thought we'd take a look at them 5 days out. So typically I look at a company that's pulled back on the day, but today we're going to do a little bit different. This one was up a little bit on the day, 0.17 or 17 cents or 0.51%. We are talking about CSX Corporation, ticker CSX, out of the industrial sector. 52-week range as low as $29.03, as high as $40.12. They are closer to their 52-week low, and they are within 15% of a 52-week low, so they'd get a check there. Market cap of $65.998 billion, a beta of 1.19. So this company is more volatile than the overall market. You can see that volatility throughout the day here, up and down all over the place, and you may be able to use that volatility to your advantage, right? Buying whenever it takes a dip, and then holding whenever it kind of spikes up. PE ratio, $18.45 per share. That's pretty decent. EPS sitting at $1.83 per share. Earnings date is coming up sometime between July 18th to July 22nd. Forward dividend is 48 cents. They are a quarterly payer, so divide by 4, though we will see that here in a minute. Low starting dividend yield on this one. This is a little lower than what I typically look at, 1.43%, but not egregiously so. Ex-dividend date, May 31st. Looks like they paid out on June 14th, so you would be in line for the next dividend if you were to buy them now, though you're going to have to wait a couple months. 1 year target estimate, at least according to Yahoo Finance, $39.15, so they do see some upside as far as stock price appreciation here. And while you waited for it to go up, you could collect that 48-cent dividend, 1.43% dividend yield. Now we're going to jump over and look at dividend yield theory to see if this one is potentially showing any value. To do that, we take a look at their 5-year dividend yield average, 1.27%. We compare it to the current, 1.43. Over here, forward annual dividend yield. I know it says forward, but it's the current, 1.43, same number as here. And since it is higher, that speaks to some undervaluation, at least according to the dividend yield theory. Now, payout ratio, I like 75% or lower. They're at 24.59, so that gives them a lot of room to continue to increase the dividend, pay down debt, make acquisitions, reinvest back into the company, buy back shares, all the things you can do with free cash flow. And I like 75% or less for a payout ratio, so they're well below what I'm looking for. Now, we're going to take a look at free cash flow. As a dividend growth investor, I want growing free cash flow because typically if a company has growing free cash flow and they're paying a dividend, they have growing dividends to match. 2021 here, you can see at 3.3 billion. 2022 up to 3.4. Now 2023 they were down slightly to 3.2 billion, and then the trailing 12 months looks like about 3 billion. So they may be down slightly in 2024, though the trailing 12 months, if you recall, takes into account part of 2023 and what's been reported so far in 2024. So we'll have to wait and see exactly what 2024 numbers are to say whether or not, but overall, even if you look at it, it is growing free cash flow for 21 and 2022, but it looks like down a little bit in 2023. So I'm not going to give them a check for growing free cash flow. I mean, it's pretty flat, but it does look like it might be down 2023 and might even be down again in 2024. Not terrible, but down nonetheless. They are repurchasing their own shares, so I like to see that. But even with the repurchase of shares, it doesn't quite account for the decrease in free cash flow because they've decreased their repurchase of shares as well. Now we're going to jump over to stockanalysis.com. I always recommend more than one source. The source you saw on the first page was Yahoo Finance. Stockanalysis.com is the second. And I always recommend more than one source so you can make sure the information you're going to get is accurate and up to date. Now they have 15 analysts that have taken a look at this. So that's actually quite a bit of analysts that have taken a look at this here. They call it a strong buy, though it is right on the edge of a buy and a strong buy. So more people are leaning towards buying strong buy than are leaning towards a hold or a sell by far. And 15 analysts is a pretty good amount there. They do have a low estimate of $25, which would be a 25.95% decrease from where it currently sits. Average estimate of $38, which would be a 12.56% increase and pretty much in line with what we saw with Yahoo Finance. And a high estimate of $44, which would be a 30.33% increase. Now we're going to take a look at statistics here. I like to look at return on equity and return on invested capital and see how well the company is reinvesting its money back into itself. And I like 10% or better for this metric. Return on equity sitting at 29.60. That's almost 3 times what I'm looking for there. And return on invested capital at 13.09% is above the 10% I look for. Now, EPS growth, I like 5% or better. They are forecasted to grow their earnings per share at 8.60%, which beats the 5% I look for. And revenue growth, though it's not great at 3.84%, they are expecting growing revenue. Now, to wrap this one up, we're going to take a look at the dividend history here. Again, quarterly payer, very low payout ratio, 26.37%. Nice dividend growth. Not quite double digits, but pretty close, 9.52%. 19 years of growing their dividend. Buyback yield to 4.66%. Very nice. That means they are very efficient with their buybacks here when they're buying back shares. Shareholder yield is 6.09%. Now, they do pay out on the March, June, September, December timeframe like most companies do. And we're going to take a look at their dividend growth here. 2021, they were paying 9 cents and some fractions of a penny. Jumped it up to 10 cents in February 2022. Looks like they rode that to February 2023 up to 11 cents. And then most recent raise, February in 2024, they raised it up to 12 cents. And I would anticipate if they're going to continue this dividend growth, they will not have another raise until February 2025. Overall, very good numbers here. Let's see how they stack up with the vested interest stock screener. So understand the business check. That's where we started. Growing free cash flow. I'm not giving them a check there. It looks like they were down in 2023. Might be down again in 2024, at least according to the trailing 12 months forecast here. Growing dividend. They do have a growing dividend. Almost double-digit growth there. Dividend payout ratio 75% or less. Yes, much lower. They're only at about 25% payout ratio. Dividend yield theory says they're potentially undervalued. Check there. They are within 15% of a 52-week low. They are not in my portfolio, so they would not be below my cost basis, but a check there nonetheless. Return on invested capital and return on equity are both above 10%, and earnings per share growth is over the 5% I look for. So that's 1, 2, 3, 4, 5, 6, 7. CSX would make it onto my watch list. Actually, I may just add this to my watch list. I've got quite a few companies on there right now. I'm not necessarily looking to add anything, but this one is interesting, so I might do a deeper dive on this one. So I really do appreciate the suggestion there, Brad. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So again, if you have a company like CSX you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below. Make sure you ring that notification bell so you're notified whenever we put out that video. And tune back in for that video in the future. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't money to never invest any amount not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel certified financial advisor.